Mortgage Doctor Rich Leffler here with another set of helpful tips to help you set yourself apart from your competition and maximize your success as a mortgage professional. And the key to what I just said was set yourself apart from the competition. In today's mortgage market, especially, it is ever so critical to be able to appear different than the rest, to do things differently than the rest. Every single mortgage loan originator out there is desperate and salivating for whatever business they can get. Business is obviously down. It will come back. Don't panic. But when a mortgage loan originator, and especially in this market, wants to be successful, they have to think of themselves as more than just an MLO. They have to consider themselves and think of themselves as a strategic partner to add value to the experience and make the customer look at them differently. So how can you add extra value to your transactions and set yourself apart from your competition, earning more referrals and customer loyalty? Well, one of the more important things that you can know how to do for a customer is help them decide on what mortgage to choose. A little bit of basic mortgage 101. Mortgage terms range from 10 to 30 years, typically in increments of 5. And the longer the term, so when we're talking about like a 30-year term, the more interest that's spent overall, the higher the interest rate, but the lower the payment, because as you extend a term out, it reduces the payment. You have more time to repay it. Conversely, a shorter term loan, such as let's say a 15-year mortgage, is going to have a lower interest rate. The borrower will own their home sooner and therefore build equity at a quicker pace. They're going to pay less overall interest, but their payment is going to be a lot higher. So what happens when a customer wants to pay off their home as soon as possible, but maybe has some reservations about a higher payment amount? Well, even if a customer can afford a lower term, it's always best to give them their options. An educated consumer is very, very important. It makes loyalty, shows them that you're interested in them, and it helps them make the best guess or the best choice for the product and service or what have you that best suits their needs. So let's say you have a customer who's thinking about a 15-year mortgage. Now, of course, it's going to be a lower interest rate, higher payment. They're going to own their home sooner, build equity at a greater pace, and save a lot of interest overall compared to the 30-year term or even a 25 or 20-year term. Well, one thing you should make your customer aware of, it's fine if they want to go with the 15-year term, but since most mortgages do not carry prepayment penalties, it might be an idea to go to a 30-year term or a higher term, a longer term, even though the rate's going to be a little bit higher. But here's the payoff. Here's the pro to that. They can always make extra payments to pay their loan down sooner without penalty, assuming there is no prepayment penalty, of course. Now, the interest rate will be higher. There's no way around that. But sometimes you think about, number one, if a higher interest rate, they're going to get potentially a higher income tax deduction, and the higher rate offsets the benefits and flexibility. Because here's what I'm thinking about and offering you the option to help your customers determine. Let's pick a random loan amount. Okay, let's just go, and I'm going to show you some, illustrate this, but I'm just writing this down from my own recollection. Let's say $300,000, and we're talking about a 30-year term, and we're talking about a rate of, let's say, 6%. I'm making this stuff up. It may or may not be market rates right now. I'm just using this as an example. Let's say if we went that option. So you find yourself a mortgage amortization calculator similar to this. And you can see the URL here if you want to grab it. It's free. It's one of my favorite tools. So we're going to show $300,000 at 6% fixed for 30 years, 360 months. Now, I always click off show amortization schedule, so I have that information at my disposal if the customer needs something else. But if we do this, let's say we go this route, the borrower is going to be at a payment amount, and again, I'm writing this down, so forgive me, of $1,798.65, and by going down here, you will see that if they went to term on this mortgage, which most people don't do, but you still have to give them these definitive terms. If they went to term on this mortgage, they would spend $47,514. Okay, sounds good. But they don't want to do a 30-year term. They want to do a 15-year term. Okay, so let's take a look at what this would mean. Let's say the rate is 4%. We'll change this to 15 years. Let's see what that principal and interest payment is going to be. And again, I'm making my notes here. So we're going to say 300K at 180 and at 4%. So now we're looking at a payment of $2219.06, which when we do the math, $2219.06 minus $1798.65 is about $420.41 higher than the 30-year option. And if they went to term on this mortgage, whereas on the 30-year note, they would spend $347,514 owning their home in 30 years. Here, they would only spend $99,430.80 owning their home 15 years sooner, meaning that they would save themselves over $248,000. Okay, they're ready to go with this. They like the payment. They think everything's good, but hold on. Because life happens, are they prepared to be obligated to a payment? And this is principal and interest only. Remember, on top of this, they have to pay for taxes, homeowners insurance, and all that other fun stuff of $2219.06. Well, let's take a look at this, because if they want to do that, it's their right. They can apply for it, their choice. But you, to add value, are going to want to give customer food for thought. So what I'm going to say here is, okay, Mr. Customer, I completely understand that that's what you want to do. And that's fine. I'm happy to take this application for you. But let's take a look. If we went with $300,000 at 6% on a 30-year term, right? But you wanted to make extra principal payments, in other words, make payments above and beyond your current payment amount, your $1798.65, to own your home in 15 years. Well, if we did this, in that case, your payment would be $2531.57. Okay, now I realize that $2531.57, because it's a higher interest rate, 6% versus 4%, is higher than $2119.06. Again, 2531.57 minus 2219.06. So you're going to spend about $312.51 a month more. But here's the thing. What happens if life happens and something gets tight, money gets tight? Are you going to be able to maintain that $2219.06? Whereas if you had this scenario, you could always then revert back and make the payment of $1798.65. So it offers you some flexibility. The bonus is the flexibility. The pro is the flexibility. The con is you're talking about a higher interest rate, which means the payment's higher. Now, that may or may not be of interest to them. But here's the thing, guys. If you give them the option, it shows that you know what you're talking about. You're providing multiple solutions, and the customer, even if they still go with the 15-year option, even if they do that, they're thinking that they at least made the most educated decision based on what's available to them. You didn't just assume, okay, 15-year, that's what you're going to go with. And you can play around with these terms. Like I said, you could go with the 20-year term, 25-year term. There are lots of different options, but I wanted to give you the gist. Now, the next thing I want to mention is, let's say that you have a customer that has to settle on this, we'll say $300,000 fixed, 6%, 360 months, 30 years, with the payment of $1798.65. And it's not so much a specific time by which they want to pay off. Rather, they want to add a certain amount of money towards the principal balance above and beyond their normal payment every month. And they say, well, what will that do for me? So I want to go with the $300,000 at 6% for 30 years. But what happens if instead of $1798.65, I paid $2198.65? Now, most loan originators, quite frankly, would be saying, I don't know, let me find out. Here's what you're going to do. Sure, Mr. Customer, you want to pay $2198.65. Let's take a look at how that would affect your mortgage. Now, here's where you're going to get rid of the term, because now you're solving for the term. So you hit calculate on this, and it comes out to 230 payments. So that equates to 19 years and 2 months. So you would cut off 10 years and 8 months from your mortgage. But instead of, if you did this, instead of spending $347,514 in interest, you would only spend let's do this a little cleaner. You would only spend 205,528.50, saving yourself. So you'd save yourself over 10 years and about 140, just under $142,000 by doing this. So that might be exciting to them. And then they might say, well, what happens about if I put $300? And you could use this to give them the information and the planning that they need. By doing this, you are an added value towards your customer. You're making a difference in their financial picture, and you're standing apart from your competition. Like and subscribe, because I'm going to have more videos coming at you with lots of other helpful tips to help you stand apart from your competition. Take care. Rich Leffler, Mortgage Doctor, signing off.